Yes, so we have studied in the previous session about the recognition and the initial measurement and then the component accounting. So we will study about the subsequent measurement now. So before we discuss about the subsequent measurement, let us have a quick recap. Okay, students, you take out your pen and paper. Then we will have a discussion together. See, what did we start with? We started with the PPE. What is PPE? A tangible asset which is used in the production process or renting to the employees and which is used for more than 1 year. Now, will you recognize every PPE as you are in the books of accounts? No. When do I initially recognize? When do I initially recognize? If I have to initially recognize, one, the cost, I should be able to measure it reliably. Second, there should be future economic benefits which should come to me. Asset has got a future economic benefit. But it's going to come to me? That's very important. No. There is one beautiful asset. It's earning cash flow. Who is enjoying that cash flow? If I am enjoying and I can measure the cost reliably, I can pass the accounting entry. What accounting entry? PPE account debit. Now, at what value I can measure it? Says at cost. Now, that's fine. But when you acquire, there can be certain three scenarios for measurement purpose. The first scenario is you will take it on deferred credit. When you take it on a deferred credit, okay, I want you also to scratch something like this. It's very important, friend. That's what I told you. No, this is mind mapping concept. Okay, you can design in your own way, and eventually will become expert in this, doing this thing. There can be a deferred credit, or there can be an exchange, or there can be purchase bar construction. Now, in deferred credit, I need to look for the cash price. And I'm going to recognize the liability to the extent of future present value of the future cash flows. In case of exchange, what I do? First, I'll check, okay, is there a commercial substance? No. Book value of the asset given up. Yes. Can you measure the fair value? No. Book value of the asset given up. Yes. Whose fair value can measure? I can measure the fair value of the asset given up. Then measure it. I can measure very reliably the fair value of the asset received. Take that. If both 1 and 2 is there, given up. What about the purchase or construction? Nice, no, see, students, why I am telling you, when you draw, see, this is a very rough thing. I wish to draw now because I got a new ideas. But if you draw this, no, your job is to refer this from time to time. That's it, how it flows, and you understand it better what you do. That is that you should take some time there. It's a part of your learning curve only, learning only. So if you are going to construct, what do you include? The cost, direct cost or purchase cost, less refundable things you are going to deduct. Then direct cost incurred to make the asset ready for use. And then decommissioning liability. What you do not include? Okay, I can say refundable tax. Sorry, not directly attributable. So many types of expenses are there. Then general overheads. Just remember what problems you solved. Sorry, abnormal losses, training, relocation, opening ceremony. So we can just go on listing, but none of these expenses are related to the asset. Followed, no? This is what we discussed. Is there anything else we discussed? Sorry? Then we discussed about the component accounting. See, now problem with this is, okay, you have recognized at a cost. It's a part of the depreciation actually. It's a part of subsequent measurement only. Like in this PPE, there is one item on which I need to replace. I can draw from here component accounting because it's a separate aspect. Then what I will do, I will break this PP into two pieces. And this component I can depreciate with the original life or the component life. This is component. Component I can depreciate original life or the component life. And it is a matter of choice to me. It is not a mandatory to me. If I do this, my profit and loss account will be fairly stable. If I don't do this, suddenly one big amount of expense is going to come and hit 5 years down the line, which I cannot provide right now because I don't have any obligation. Follow, no? And when you talk about the decommissioning liability here, it is the present value of the future cash flow. Means it is not a financial liability for you, it is a provision which you are going to debit the PP and credit the provisions. Okay, so this is, I think this is what we discussed, and this is what we fairly covered yesterday's discussion. Cost, future values, yes. See, like this it will go on. So you should be in a position, see, not everything, it is a vast actually. But what is that? If I have to solve the problem, what all aspects I need to remember? That if you can capture in 1 or 2 pages, because a lot of things are theoretical. Then you see my chart book plus your chart book. Together, you can have a quick revision from time to time so that you retain what you study. So that next time when you solve this, since you know these provisions, you know the adjustment, why we are doing that. Yes, so next we will move on to the subsequent measurement. How do I subsequently measure? See, for a financial instrument, subsequent measurement depends upon the classification. Classification depends upon test. But for a PP, there is no such classification, there is no such test. Class is there. There is something called a class of assets. But test and all are not there. So, entity may choose, but there is a choice. Either cost model or revaluation model. That means you can choose to do it, maintain at a cost only, your assets, or revaluation, and it is a policy choice. But whatever you do, 2 things. One, you need to apply it consistently every year. If you change it, this becomes a change in accounting policy which applies retrospectively as per Ind AS 8. You can't simply play with it. Oh, I will make a good profit this year, let me change. That is not permitted. Second, you need to apply for entire class of PP. Now question comes, what is class of PP? This is the grouping of the assets of a similar nature or its use in the organization. Like land is my one class. I have got a vacant land and I have got a land where do I dump something, landfill I do. Both are different class. Because a vacant land has got a different value, different use. A dump yard has got a different use. Land with the building is a totally different there. A vacant land is different from, see, in your building we discussed yesterday. When we talk about a construction of the building, we can say total, but when it comes to depreciation, we bifurcate. Land cost is so much, depreciation cost is, for depreciation, depreciable cost is so much. That land is totally different from a vacant land. So machinery, ships, aircraft may be different from a ship. Now why we need this class? Because when we apply cost model or revaluation model, it should be applied class wise. That means aircraft I can go with the revaluation model, but all the aircraft I should do revaluation. Ship I can go with the cost. I cannot change as per my convenience. I should apply all the, if one factory building I go for revaluation model, all the factory building revaluation model. At the same time I can maintain office with the cost. Both are different class. So how does that measurement starts? The basics, we have studied this. You always measure initially at cost. It's called initial measurement. Suppose subsequently if you adopt fair valuation, then fair value adjustments are going to happen up or down. Then you start charging depreciation on this cost or the revalued amount. Because revaluation happens, then revalued amount is going to come into picture. Then there can be certain revaluation adjustment, additional depreciation may come, because this depreciation will be on the cost. This depreciation was on the revaluation amount. There can be impairment loss, and this becomes your book value. So generally they ask you, what is the book value of the asset? So we have to start with the cost. Cost all part we have done. hardly we charge the depreciation also. Now, accounting for the revaluation model is summarized as below. See, cost, there is no headache at all. Life is very simple. But if somebody goes and choose the revaluation model, OCI comes into picture, because revaluation surplus is one of the item of OCI which is not subject to recycling. So, how to transfer the gain, how to treat this revaluation gain? Understand this logic very well. Huh? Now, if you do the asset first time revaluation, first time, before that you never did, it's the first year it came. And there can be only two possibilities, or I can say three possibilities. Its value remains the same, value increased or value decreased. So let me take about the value increase. I will transfer this to OCI as a revaluation surplus. My accounting entry is what? PPE debit to revaluation surplus, OCI. And from OCI I will make one column there and it continue to keep there. Now what about the first time decrease happens? Then I will charge to P&L account. Surplus will go to OCI. Deficit will the reserve. Negative reserves I don't keep there. Now I will go to the next year. Now comes the catch. Next year, second time when I do revaluation, see, generally revaluation is done every 3 years. Not every year, people don't carry that. Third, because it's a cost. No, you have to call a valuer. You have to ask him a valuation of the building. He will charge you hefty fees for this. So people don't do it every year. Now the third year or whatever, subsequently when you do it, then also again increase happened. This time you first ask yourself, what happened last time? Was the previous increase or a decrease? If first time there was an increase, second time also there is an increase, you straight away take to OCI. But the first time there was a decrease, second time there was an increase. So what did you do when the first time it increase, decrease happened? You charge to P&L, no? So how much you charge to P&L? First you recover by recognizing the gain. You recover that back. If still something left excess, that excess becomes OCI. Logic is simple. First time, because it's unrealized, no? And this is what standard says. In accounting standard, all these concepts are not there. But Ind AS comes with one OCI statement and it says that which all items should be transferred there. Because for me, a revaluation gain is not a business income, no? It's my asset and it's not, I'm not having any control over it. Point number one. It's unrealized. Point number two. Again, third is no control. So that's why, otherwise I will take it to P&L account, then nice, no? I will buy the land as evaluated and say it's my profit. People will ask, no, what is your performance? You say profit, I agree. Show to me during the year how much profit you made. But don't show me in the P&L account, give me a separate statement. Now second time, decrease happened. Again you will ask the same question, what happened last time? First time increase happened, second time decrease. Okay, let me go like, first time also decrease, second time also decrease. Straight away it will end up in the P&L. But first time there was an increase, you created one reserve. Second time there was a decrease, no? First you eat that reserve. Because you created one reserve, no extra. And then you transfer to P&L. I hope this explanation is sufficient. See, for your understanding, I have given one example, not required as such. You can go through this, like I have given with the numbers. Like first time, historic cost is how much? 100. First time increase happened, decrease happened. Increase you take to OCI, decrease you take to P&L. Then subsequently, increase happened, one scenario. So first time also increase, second time also increase, you take to OCI. First time decrease, second time increase. 50 you recover. This 50 you are going to recover. And balance 100 only will take to OCI. Overall level only 100 you are going to take. So cumulative effect will be net increase is 100. And you see that net is either sitting, if it is a net increase over your original cost, then it will be in the OCI or the P&L cumulatively. Similarly, I given the opposite example. First time there is an increase, decrease. Second time there is a decrease. First you recover that OCI and then you transfer to the P&L or you transfer to the P&L. So cumulatively you have got the same. Since there is a decrease, no OCI is going to come into picture. Now excess depreciation, the moment you do the revaluation, depreciation is going to increase going forward. Then you have got one choice. This is called accounting policy choice. Remember that whatever extra depreciation comes, no. See, if there is a fall in the revaluation, depreciation also will fall. And fall in devaluation will go to P&L account. Nothing doing. But if you have increased the revaluation, you would have created one reserve. And next time, depreciation also will increase. Your P&L effect also going to increase now. Then you say, sir, see, that reserve is unrealized. Why you want me to charge that depreciation? Like, you should help me, no, because depreciation cost has increased. That's why the standard has given one choice that in case that extra depreciation comes, no, if you want, see, first thing is on revalued amount you charge depreciation straightforward entry, and this you take to P&L account. And to the extent of that extra depreciation, you transfer from the revaluation surplus to the retained earnings. This is no recycling. Means you don't bring it to the P&L account, but from then and there you transfer, you reduce that balance. Are you clear about this? Yes. So now we will solve some of the problem. That's it. They're very simple. Yes. So measurement we discussed, cost and revaluation model. This is the policy choice, excess revaluation. Yes. Take out question number 12. Jupiter Limited has an item of PPE with the initial cost of 1 lakh. What is this 1 lakh? Whatever cost of construction, acquisition, barter, you name it, that initial PPE entry. At the date of revaluation, that means you must have followed revaluation method, accumulated depreciation of 55,000. The fair value of the asset by reference to the transaction in similar asset is assessed to be 65,000. That means 1 lakh is the book value. There is one more policy choice, okay? I will update that in the chart later. I'll explain that while following this problem. What is that policy choice? You minus 55,000. That means 45,000 is book value. It is upward revalued to 65,000. Now, how do you account this? What is the entries to be passed? Now, again, there are two policy choices. The policy choices goes something like this. One is the, see, this is the revaluation model. You opted for revaluation. Now, model number 1 or method 1 is to remove all the balances. Whatever accumulated balance is there, you close that, clean, make it clean, and start with the fresh balance. Alternatively, when you do the revaluation, see, now what is my book value? 45, no? Make it 65. Alternatively, 1 lakh you increase, accumulated depreciation also you increase. This is method number 2. Okay, so let us solve this. First, calculation of the revaluation gain. Working note number 1. Always when they ask you, they asked me pass the journal entry on the revaluation. Now, let us do both the methods. What is the book value? 1 lakh minus 55,000, 45,000. Revaluation 65,000. 20,000 is the gain. Revaluation gain. Actually, this should go to OCI because it's the first time. You can write in bracket OCI because this is the first time revaluation happened. Previously, they didn't tell me that revaluation happened. So, we will go for, they asked me pass the journal entries. First, write method 1. This is depreciation elimination approach. So, under depreciation elimination, first you write accumulated depreciation account debit. How much? 55,000. Because you have got a gross block and accumulated depreciation now. 2, cost of PPE. By passing this entry, whatever accumulated, because generally what you do, what is the accounting entry you pass every year under cost model or whichever model? Depreciation to accumulated depreciation. Then you pass one more entry, P&L account debit to depreciation. And this accumulated depreciation you deduct from the gross block. This is what you do. First you remove that accumulated depreciation, gone. Your gross block also came down. Your accumulated depreciation vanished, finished. Then you pass one more entry, cost of PPE account debit to revaluation reserve OCI, 20,000. Now your gross block is restated at 65,000 net, and you again begin with one new life of accumulated depreciation. Going forward, whenever you pass, you want a depreciation. What is the book value? 65,000. What is your life? Say 5 years. So 65,000 divided by 5, 13,000 every year you are going to charge. What entry you pass? Depreciation to accumulated depreciation. So next year again, 65,000 is your gross block minus accumulated depreciation is 13,000. This is your net block. Like this you will go on. Again third year comes, you do the revaluation, kill whatever 13,000 into 2, say 26,000 is the accumulated value, kill that. Again restate, again start doing accumulated depreciation. Like this you go on, continue. Are you clear how the accumulated depreciation or depreciation elimination method is going to work? Yes. So these are all my accounting entries. The second method, and generally you can go for this method, if the question is very silent, you can do this method. Second is called a restatement approach. Generally 1 or 2 problems you must have done it, but be careful what they say. For this, no, you need to figure out percentage of revaluation surplus. How much percentage it increased? Can you tell me, students? You have done on revaluation. By what percentage there was an upward revaluation? Sorry? 44? Sure, everyone? Vishnupriya? So how did you get 20,000 divided by 45,000? This is the net book value now. You say 44.44%. So you pass only one entry, PPE at cost or gross block of PPE. You can call gross block also. How much? 1 lakh into 44.44%. 44,444. 2. Accumulated depreciation. How much? 55,000 into 44.44%. 24,444. 2. Revaluation reserve OCI 20,000. If you see, the net effect going to the revaluation reserve is same. Under the first approach, you eliminate it. Here, you go on restating it, both the gross block also, accumulated depreciation also. This is the policy choice. Question tells you specifically do this method, take that method. Else, you revert to the first method, depreciation and elimination. You eliminate that because that's simple, right? Instead of restating this PPE, gross block and all. Are you clear about both the methods? Now comes one more question. Sir, because of this, look, I am charging now extra depreciation. Some element of extra depreciation is going to come from next year onwards. That extra portion I can reduce this revaluation surplus into retained earnings. That is also, if they tell you, you have to do it. No, don't take such assumptions. Go to question number 13. X company performed revaluation of all its plant and machinery at the beginning of 2018-19. The following information they have discussed. Gross block they have given you, accumulated depreciation, net book value and the fair value. So how much is the revaluation surplus? 30. Is there any previous revaluation details they have given you? No. So you assume that this must be the first time they have done. If they told, then something must have been, they would have told you something. What happened last time? The useful life of the machinery is 10 years and the company uses SLM method for depreciation. Sorry? 120 is the net book value. See, 200 minus 80. Revaluation was performed, the revaluation was performed at the end of the 4th year. This exercise was done at the end of 4th year. Okay, so now 200 divided by 10, let us do, I don't know how much it comes to, 20 per year depreciation into 4 gives you 80. Now it makes sense to you. That means 4 years back you purchased, and probably this is the first time you are doing revaluation. You have on day one only you told everyone, look, we are going to go with revaluation. Probably values didn't change, so you didn't find that okay, it's the makes sense that to do the revaluation. Advice: how should the company account the revaluation of plant and machinery? Subsequent to revaluation, support your answer with the journal entries. You have to pass the journal entry, but how do you advise how such company should account for revaluation? How should you account for the revaluation? This is easy, no? Calculations are easy. How many marks this question may come for? 6 marks. How much your workings may fetch you? Journal entry 1 or 2, yeah, that somewhere 2 to 3 marks is the theory here. What theory you are going to write? Tell me in your language. Advise how the company should account for the revaluation. You can assume it is the first time revaluation. OCI, okay. How do you transfer it to OCI? Is there only one? See, advice means what happened, no? When somebody will come for your advice? They don't know what to do. They have to take a decision now. And problem is there are options. That's why they come to you. Should I do CA or should I do MBA? I'm okay. Or yeah, there's some confusion is there. I am not much clear about certain things. That's what you need to figure out, all the information. But whenever they ask you the verb called advise, you see that there are some choices sitting. That's why people go for an asking advice, no? Now, what is that advice you need to give you? What are the choices available? Is there any choices available to you? Sorry? Depreciation elimination approach or this approach? Followed? No. Then based on that advice, you have to support your answer with the journal entries. So, whenever these verbs you see, that gives you actually an approach how to should start your answer with. If you don't give importance to advice, you think that advice is just like theory, like any other thing, then you don't know what to do. Now, are they asking advice on your revaluation? No. If this asset is purchased for the first time, then advice will come. What is that? Should I follow cost method or should I follow revaluation method? If you follow revaluation method, then advice is going to come. But if they would have opted for cost method, they will never ever tell you advice. Possibility is there. Should I shift to revaluation? Advice. Then you need to tell, look, you can shift to revaluation, but this has to be retrospectively applied as per Ind AS 8. This is your advice. If you do this, this is the things you need to do. Follow, no? Write the solution. See here, since advice they have asked, I don't need to talk about the first part. Should I go for cost or revaluation? And if there is no confusion on the first part also, like if there is a revaluation surplus, should I take to OCI? That is known there. The moment you take one choice, it is known that you have to go there. But again, after some time, you get some options. So, right, as per Ind AS 16, clear, no students, how to interpret that verbs. As per Ind AS 16, when PPE is revalued, what happens? The carrying amount, book value is our layman language, carrying amount is the standard language, is adjusted. Okay, carrying amount is adjusted. Such adjustment is done one of the following way. In bracket you can write policy choice. See, you communicate very clearly what is your idea. One, accumulated depreciation is eliminated. Is my answer complete? What? Can you help me to complete this? Accumulated depreciation is eliminated. By 2 gross block. Okay, you can say against gross block. See, this is a complete sentence. They may not go that much minutely, but you have got a practice, no? Second, both gross block and accumulated depreciation is restated proportionately. Both gross block and accumulated depreciation is restated proportionately to change in book value or carrying amount. Are you clear about this theory? Yes. So write option number 1. So this is the first theory, first part of the theory for your advice. What you can do. Option 1, gross block represent here. That means anytime gross block will represent here fair value because revalued amount. So you pass accumulated depreciation account debit to PPE. How much? Then PPE to revaluation surplus 30. For me, 2, 2, 2. 2 marks each. Clear? Second, method 2. I need a percentage of surplus. How much? %, which is 30 by 120. So my entry will be PPE. How much? How much is my PPE? I will tell the journal entry. PPE to accumulated depreciation to revaluation surplus, and I will help you with the third one, 30. PP 150. $50. How much is my PP? 30, 50. Yes, Vishnupriya. Vidya, what is your opinion? How much is my PP? How much should I write? See, we have done it previously, and I hope you have understood it. What we have done that. That's why I tell you, please tell me the number to test. Otherwise, you will write 50. See, already 200 is there. The 200 should get restated by extra. How much? 200 into 25%. Followed, no? Not the whatever, I don't know. 120, I don't know what you from how did you get 150? But what I am trying to show now, if in my new balance sheet, it is 200 plus 50. In the previous balance sheet, what is my gross block? 150. Accumulated depreciation not there. That means if I go, I should see the restated value as if it is first time it is purchased now, as if just now it is revalued. Here from history will be, I am keeping the history. Okay, what was there? Now how it is revalued? So it is 20-year accumulated depreciation and 30 will go to the revaluation surplus. Right, depreciation. We are not done. Advice now. Option 1. We got an option also. How do we going forward charge the depreciation? Since revalued amount, that means if we opt for the first one, if we opt for the first method where we will eliminate the depreciation, the revalued amount is the gross value to be considered for remaining useful life. Underline this. Therefore, depreciation charge will be 150 divided by how many years? 6 years. That means rupees 25 per annum you are going to get now. You have to advise that also. Now, otherwise, you see, first method you advised. It's a half and half advice, no? Like somebody is advising, go, enter that Chakravyuha. Only half. Coming out not advised there. So like you told, okay, follow this gross block method. I'll ask you only one method, one question. If I go for the second option number 2, can you tell me how much depreciation I should charge going forward? If I go for option number 1, you say me, sir, charge depreciation 25. If I had to go for option number 2, how much depreciation I should be charging going forward? Then it becomes a complete advice. Then on top of this, you can tell one more thing. Since you have done the revaluation surplus, you can transfer it to the retained earnings every year, that excess depreciation. What was previous depreciation? 20. What is new depreciation? 25. 5 is that extra. Extra you can charge to the revaluation surplus, means transfer to the retained earnings. Just tell me. No, logically you tell me one thing. Should it be different from 25? Then I will play no. See, both the method gives me the same balance of revaluation surplus, no. So logically, whichever method I follow is the presentation. It should give me the same amount of depreciation. It cannot give me the different amount of depreciation, no. So if I opt for option 2, gross block is restated, depreciation is equal to 250 divided by 10 years. Original gross block for how many years? Did you touch that? No, you say that that original item is still there with me. What's the total life? It is restated, no? 25. See, now this is beautiful advice. Like this advice you should give to the client. That's why they use the verb called advice. On top of it, if this question comes for 8 or 12 marks, no, I will go one more step now. See, previously you were charging 20, now going forward you charge 25. 30 revaluation surplus is created there, correct, no? So transfer this 5 every year to revaluation surplus and kill it. So anybody gets your advice, no, they feel very happy. End-to-end advice is given. So this question is important question. Now, what is your depreciation entry? Depreciation to depreciation. Because they asked you journal entries, no, along with the advice. See, one question, and it is an RTP question. It's my guesswork that they may charge you, they may provide 6 marks for that. I don't know at what. See, we have already seen a 5-mark question, they will ask you for 10 mark. 10-mark question, they will ask you for 5 marks. That you have to apply your judgment at that point of time. Should I touch it? How much should I write it? Should I follow some shortcuts? That's your judgment. I cannot tell you at this point of time. Are you clear? Yes. So we'll move on to the question number 14. An item of PPE was purchased for 9 lakh rupees on 1st of April 2011. It is estimated useful life for 10 years. So how much 90,000 depreciation you will charge every year, SLM basis. How many years are over? 2002, 3. 2 years are over. After 2 years, the asset is revalued to 9,60,000. The useful remains unchanged for 10 years. That means how many years remain? 8 years remain. Ignore the impact of deferred taxes, thank God. Otherwise, you should have created one deferred tax entry also for this. Because revaluation may not be accepted by them. Your fair value of the assets got changed. But as per income tax record, you have got other things. Okay, that how the but we will not escape. In deferred tax, we will study. When the revaluation is going to happen, how to create a deferred tax for the revaluation. You have to create two components there. Deferred tax on depreciation, deferred tax on revaluation. Show the necessary treatment as per Ind AS 16 to calculate depreciation and revaluation surplus for 13-14. Because you did revaluation on 1st April. That means 13-14 means 31st March 2014 they must be asking. In the new scheme, this was the old study material question. They started to use the calculator is used here. Depreciation and revaluation surplus for 13-14 as per Ind AS 16. Should I write theory? No. Doesn't seems to be a theoretical question. Simply they said calculate depreciation. We'll calculate the depreciation and the revaluation surplus. So what is my cost? ₹9 lakh. Now I need to do a revaluation. So like less accumulated depreciation. How much? How much is my accumulated? 1,80,000. 9 lakh divided by 10 into 2. So 7,20,000 becomes your book value. What is your revaluation? 9,60,000. So you have got 2,40,000 revaluation surplus which you transfer to OCI. But when did you do this? At the beginning of the year. Be careful. This happened at the beginning of the year. When they asked you at the end of the year, what about that extra depreciation? Have they told you anything? Have they opted for that transfer to the revaluation surplus? Because by that balance, this balance is at the beginning. Please keep in mind. This is on 1st of April 2013, not at the end of the year. End of the year, if the policy is opted, then this balance will change. Otherwise, this balance will remain as it is, unless the second revaluation is going to happen. Now, what is your additional depreciation second year? How much additional depreciation you charge? That means they must have opted for that. Opted, no? Question is talking about that? No. What may talk? Exam may talk. Otherwise, it's a simple question now. Do you think why insurers give this question? It's a child's question. Now, what they may, because if I look at the solution, they have transferred that extra depreciation to retained earnings. Question is totally silent about it. In one problem they have done, another problem they have not done. Students will get confused naturally. And to understand it, you have to study entire study material. Somewhere you have to understand some other problem. There is a policy choice. Followed? So be careful, in exam they may ask you. Even though they don't ask, if this question comes, since you remember it, okay, you have to do it. So how much is additional depreciation? Depreciation after revaluation, how much? 9 lakh. How much amount? Depreciation after depreciation. One amount, 96,000. Be careful. Amount, one amount you tell. 1,20,000, 9,60,000. This is for how many years? 8 years. Why you are dividing by 8? You are assuming that accumulated depreciation has been written off. Or which method you follow? Did you follow gross block appreciation method or depreciation elimination method? Elimination method. That's why you divide it by 8 years. If you would have adopted that gross block restatement approach, then you would have figured, did you calculate the percentage of increase? No. That itself means that you must have adopted the first method. And I told you, if the question is silent, go for the first method. Yes, Prithvi, are you clear? Did you understood the catch here? It is a simple actually, very simple, but complexities are little done without giving full information. Minus, what is your original? 90,000. So, extra depreciation becomes 30,000. So, you are clear now when we are solving this, which assumption they have taken? They have not spelt it very clearly in the question. And my experience is in examination, they give more clarity. I showed you also. At the same time, some time examination, they don't give clarity because they are unpredictable. They don't want to get predicted. What is ICA? So, in P&L account, 2013-14, depreciation expense of how much is charged? Rupees? How much depreciation I will charge to P&L account in the year 13-14? That means at the end of the 2014. 1,20,000. So 1,20,000 I am going to charge depreciation. Now, as a matter of policy choice, entity may write down revaluation surplus by increased depreciation. So, the journal entry will be revaluation reserve OCI to retained earnings 30,000. This is that extra depreciation. Now they asked you, what is your balance? Depreciation they asked you, you worked out and told. The last thing they asked you, what is the balance of the retained earnings at the end of the year? Revaluation happened at the beginning of the year. Are you clear? So the balance, revaluation balance, opening balance, how much? 2,40,000 minus transfer to RE, retained earnings, 30,000. So you have got 2,10,000 as the closing balance. If you have opted for the first method, then depreciation will be total block minus total life, not for the remaining life. And have they told you anything, any hint on first of all? No, question is very silent about whatever you did. Yes, so we will move on to the next MTP question. This is for 5 marks. X purchased the property, plant and equipment 4 years ago at 150. Depreciates on 10% per annum on straight line basis. How much? 15 rupees every year. At the end of the 4th year, revalued the asset to 75 lakhs. Return of the loss on revaluation to the P&L account. Understood? Why? First time revaluation loss came. However, on the date of revaluation, the market price is 67.5 and expected disposal cost are 3 lakhs. Impairment. You have to test for impairment. Anyhow, we will discuss later. It's a small thing. I'll explain you. What will be the treatment in respect of impairment loss on the basis of the fair value for the revaluation surplus? Now, again, there is one more choice, one more thing. That means if you incur any impairment and already some revaluation surplus is sitting, again you can eat that. revaluation surplus. Okay, so this is the value revaluation purpose determined by the market value, and the value in use is 60 lakh. Okay, so later we are going to learn the chapter impairment. Impairment is equal to nothing but carrying amount minus recoverable amount. Recoverable amount is the higher of value in use or fair value less cost to sell. The logic here is recoverable amount means how much cash you are going to get, and there are only two ways you can get a cash from the asset. What is that? Use it, sell it. Financial asset, we also say no. Either retain it, hold to collect, or you sell it. Whichever is high, that is what you are going to do. That is your recoverable. So they told you fair value this part, value in use is this. This has to be compared with the carrying amount after your revaluation. Check is there any impairment or not. Are you clear? Did you get the flow? Yes. Calculation of the revaluation gain or loss. First step. What is your cost? Prithvi, are you clear? No? Higher of value in use or fair value? Fair value. Now, if you retain with you, why you retain some asset? It will earn the cash flows in the future. What is its present value? That's called value in use. We will discuss in detail about it. Don't worry. At this point of time, just remember one equation of impairment. In fact, it's not something I should tell you. Intermediate, I believe you must have come across this equation. It's not something new. What is your cost? 150 less. What is your accumulated depreciation? 60. How did you get? 150 into 10% into 4 years. 90 less revaluation 75. This is the first time revaluation. So 15 you charge to P&L account. They told you, but not required. You know that. There is no revaluation surplus sitting now. There is no revaluation surplus. Clear? Now we need to calculate the impairment loss. So, calculation of impairment. See, what is your book value? 75. Once you do the revaluation, your book value is the revalued amount, no? Which method you follow? Depreciation elimination method. Assume. Otherwise, book value would have been very high. Means gross block would have got restated. Minus recoverable amount, which is higher of value in use, which is 60, fair value less cost to sell, which is 64.50. So 64.50. So this comes to 10.5. This is your impairment loss. This also will go to P&L account. If there is an upward revaluation done previously and you incur impairment loss, it is like a downward revaluation. You take that first. So impairment and revaluation is almost, both are not same, both are different. What is the difference between a revaluation and impairment? We will see that later, because downward revaluation and impairment sounds same, but both are different. One is policy choice, another is compulsory for you. In Ind AS 36, we will understand the difference. Okay, are you clear? Now write, since the impairment loss of 10.5 charged as expense in P&L immediately, as there was downward revaluation. So you're going to tell that, look, the whatever impairment loss you incurred now, you charge to P&L account. This is the accounting treatment. What is the question? The question asks us, what will be the treatment in respect of impairment loss? On the basis that the fair value of the revaluation purpose is determined by the market value, that means 67.5 minus 3, and the value in use is 60 lakhs. Now in exam, what they may ask you? What may happen in the examination? So you explain the treatment of impairment loss, simple, finish. Can this question come as it is in the exam? Can they twist it? If it comes as it is in the question, well and good. What may happen is, revaluation surplus may come. In this revaluation, downward revaluation happened, it's a loss happened. So when the revaluation surplus comes, your answer is going to change now. Impairment loss calculation and all will, that procedure remains the same, but here you said that, look, it will be removed from the OCI. First it is consumed from the OCI, and then excess will be charged to the P&L if it is not sufficient. Are you clear? Very clear? What is that concept, how it is being used? Yes, good. Now Heaven Limited purchased a machinery on 1st of April for 30 lakhs, which is reflected in its book on a WDV of 17.5 on 1/4/2006. So 2001 it purchased, 2, 3, 4, 5, 6. After 5 years down the line, it was 17.5. So we understood the difference is the accumulated depreciation. The company estimated upward revaluation of 10% on 1st of April only, beginning of the year, to arrive at the fair value of the asset. Yes, what you will do? That excess amount you will transfer to OCI. Heaven Limited availed the option giving the transferring some of the surplus as the asset is used by the enterprise. See, no choice here. Huh? That means that extra depreciation, what we did know, there was question was totally silent. But you see how they will ask you in the examination. They say that there is one option and they opted for that. In 2008, 1/4/2008, that means again after 2 more years, 2006, 7, 8, 2 years finished, and 3rd year first day, the machinery is revalued downward by 15% now. And the company re-estimated the remaining life to be 80 years. Now on 31st March 2010, 2 more years went on, machinery was sold for 9,35,000. The company charges depreciation on SLM. What you need to just prepare the machinery account in the books of Heaven over its useful life to record the above transaction. So what do you need to do here? Important question, test your knowledge 11, which is updated recently, okay? Is a news here. I think I have written NSB there. Not written, because previously I don't think so this was available. It was there in November 21 RTP. Okay, how do you do it now? What we need to do? We need to just prepare a machinery account. For machinery account, what do we need? It's a debit and credit to purchase, like whatever, by depreciation, balance carried down, by depreciation, revaluation. So we need certain calculations to be done. What is the first calculation I should do? What do you think? Okay, let us first do the useful life. Like, let us go one by step, because this question may carry step marks if it comes for the exam. So write first working note, solution. So can you tell me, students, how much is my useful life? See, can you tell me, have they told me originally how much is the useful life? Can you arrive at that useful life? The question is clear. See, they said me what? You purchased 1st April on 2011. Then you charge some depreciation. Okay. And on this day, 2008, you said the remaining useful life to be 8 years. Okay, how did you get 12? Okay, others. Yes, students, so please pause the video before we proceed and calculate one useful life. Yes, students, I hope you have got that. 12 years. Okay, how did you get the useful life to be 12 years? How did you do the working? So, useful life will be, see, first thing you will take the, how much is the depreciation charge for 5 years? Right, you can solve this along with me. So, 30 lakhs minus 17 lakh 50,000, 12 lakh 50. Per year, 12 lakh 50,000 by 5, 2 lakh 50. Therefore, total life will be 30 lakhs divided by 2 lakh 50 is equal to 12 years. Now, out of 12 years, see, understand here, why I need the life. Out of 12 years, 5 years finished. How many years remaining? When you did that first revaluation, 7 years. But if you see, after 2 more years, they revised the 7 years into 8 years. Means 5 years remained again. 5 years again, life also got re-estimated. Changes have happened. Followed, no? So that's why first we need to keep in mind, first part, okay, that life of the total assets is 12 years, which at the date of revaluation, 5 year over plus 7 more years. So this is the way institute has calculated. They calculated 2 lakh 50. They said how much is remaining, how much original, 5 elapsed and 12 years. Followed, no? Okay. So how much is the depreciation after upward revaluation? Because they have opted for a policy choice. So write second, depreciation after upward revaluation. When the revaluation happened? 1/4/2006. So what is the book value on 1/4/2006? 17 lakh 50,000 plus 10% upward valuation, 1 lakh 75,000 divided by 19 lakh 25,000. How much depreciation you are going to charge from 31st March 2017 onwards? How much? How much depreciation you are going to charge? This is what our heading is, 3 lakh 85, 2 lakh 75, different numbers. Any others? What is your calculation? Yes, students, you can also do the calculation. I want everything. Before I do it, I want you to do it. Because you need to be very clear about the flow there. What happened first? 2 lakh 75, yes, Vishnupriya, 275. See, this is when 1/4/2016. From now onwards, how many life is pending? 7 years, no. Total 12 years. Out of that 5, I finished. Why 10 years? No. Again, understood, no? It is you have to understand the flow. This is a very new question. Practice it very properly. So 19 lakh 25,000 divided by 7, it comes to 2 lakh 75,000. Yeah, tell me. When remaining life is 8 years? 1st April 2018. Okay, so now we are into 2016. 7 was there. 17 and 18. The life is going to become 5. Now this 5 is re-estimated to be 8. It's called a change in the estimate. which gives prospective change now. Depreciation is going to change when the life is changed, but not right now. Future, no. Now, at this point, you see, you go in one chronological order. What happened on day one? I purchased. What happened next year? Nothing. Depreciation. How much? Whatever it is. Next 5 years, nothing happened. I do devaluation at the end of 5th year. How much? 1,75,000, because every information is given. Now, because of this, they told that there is a policy choice. If they would not have told me, then why I want that? Straight away I would have gone. Per year depreciation I would not have calculated. Previously, I know 2,50,000, 25,000 extra now. Now, that change in the life we will see later. One by one we will address. So, are you clear? 2,75,000. Now, third, working note number 3, depreciation after downward revaluation. Again, see, from now next year onwards, what happened? 2,75,000, 2,75,000 is charging. Now, can you tell me when the downward revaluation happened? 1/4/2008. So, what is my book value on 1/4/2008? What is my book value on 1/4/2018? 1 minute. 19 lakh, 25, 19.25, no? 1 lakh 17 lakh 50. You see here, 17 lakh 50 plus 1 lakh 75, 19 lakh 25, no? So, this mine into or minus how much? 2 lakh 75 into 2. Okay, how much it comes to? 5 lakh 50 gives you 13 lakh 75,000. Clear? Now, this got downward revaluation by how much? Minus 15% downward revaluation. 2,06,250. Book value is 11,68,750. What is my depreciation every year from 2018-19 onwards? You can see, no, how they can complicate things. Nicely add one content there. Depreciation, revaluation happened. They take it. See, now we are not complete. In between, that extra depreciation I was taking from the retained earnings balance, that revaluation surplus balance. So, how much is the balance in depreciation? 46,000. How? 11,68,750. Now, life got reversed for 8 years. 1,46,094. Are you clear? 1,46,094. Now, how much you need to transfer to the retained earnings because they opted, no? Now, write working note number 4, amount transfer to retained earnings. Or you can write the heading balance of retained earnings. 4, balance of revaluation reserve. What is your opening balance? On which day? 1/4/2016. That's the first time revaluation happened. How much? 1,75,000. How much do you take out transfer on extra depreciation? 25,000 per annum. Yeah, tell me. See, because of this revaluation, you started charging extra depreciation, no? What was your original depreciation? 2,50,000. How much you charged extra because of revaluation? 75, 2,75,000. So 2,75,000 is the depreciation which you charged as per working note number 2, extra depreciation, minus 2,50,000 what you have been charging originally. This exercise happened into 2 years. So it become minus 50. So it become 1,25,000 on 1/4/2018. This is your revaluation surplus balance. This is when 1/4/2018. 1/4/2018, what happened? No, will you see why you didn't continue afterwards? See, this you should have done continuous. No, this excess depreciation, why you are charging only for 2 years? Why not 3rd year, 4th year, 5th year? Again, revaluation happened. In that revaluation, what happened? It got downward. How much was the downward amount? What you will do that? What you are supposed to do? What you are supposed to do? Yes, no. Generally, revaluation, downward revaluation, where you will take P&L. Which first time or subsequently? This first time. This on 1/4/2018 is the first one or the subsequent one? Subsequent one. When you do the subsequent one, will you take to P&L? No. You will ask one question: what is my previous thing? Previously revaluation surplus. So what do you need to do? You have to consume the balance sitting in the revaluation surplus. But that revaluation surplus balance is not a simple balance, because you have opted one policy choice there to transfer this excess depreciation and eat it. In between, impairment didn't happen. God's grace, ICI is so kind and considerate. They could have added one more masala no there. In between, the impairment also happened. The COVID came 2022. Then again, my revaluation balance would have gone down there. Depreciation would have got revised. So next, fifth one, P&L transfer on downward revaluation. See, are you getting a flow, students, here? A very clear-cut flow. What is happening? With this, machinery account is nothing. You should prepare now. I am not going to prepare. Maybe I will help you with the first year. Okay, are you clear? So, what is the downward revaluation amount? You say working note number 3, 2,06,250. If it was first time, you would have taken to P&L account. If it was second time, but if there is no first time also P&L, the second time also you would have taken to P&L account. If it is second time, first time OCI, balance has become 0, you would have taken to P&L account. But problem is there is some balance, less revaluation reserve balance. See, when you should say OCI only one time, next time don't tell OCI. The day it comes, when 2016, that year only you have to say OCI. Only in that year's P&L, and see, after P&L you have got OCI statement, no? It will come that year only once. From then onwards, no, it will get accumulated in one column and you call it revaluation reserve. OCI is the first year when that entry came. That's it. That's OCI. Afterwards, you don't call it. Now I should not call it OCI. I call it revaluation reserve balance of the other equity. Clear, no? How much? 1,25,000 from working note number 4. So you take this and 81,250. Done. See, with these 4 workings, you have got a very clear. You please mark it very important, not just important, very important. With these 4 workings, you are done with the required inputs. So write the heading in the books or machinery account. They asked you machinery account, no? Date, amount, when this machinery account makes one opening, when, what is my entry? Machinery to 1/4/11 to bank bar vendor. I don't know how much. 30 lakhs. Then by depreciation. Okay, when 31st March, 31st March 12, by depreciation 2,50,000, by balance carried down 7,50,000. It is a simply waste of time now. We are eating our time, right? Huh? 5, no, machinery account they asked. No? That's what they are simply consuming your time there. Maybe see, you can do like this. These balances you don't enter. You keep it later. Followed, no? Means keep it blank. Straight away start with this. You look at the marks, huh? How much marks they will ask. You have to take a decision. Then 31st March 13, depreciation 2,50,000, balance carried down 25 lakhs. By depreciation, see, you can do it like this. See, balance carried down. Don't write by balance, to balance. That you can fill it later. By balance and to balance. No? Just write one by balance. 2250. Okay, 4 years I will help you. I could have helped you on 5th year also. But I want you to do it from the 5th year onwards. Till when? Till when? Huh? Till when? Sale. They sold at 9,35,000. When, see, this had got still life of 5 more, 8 minus 2, 6 more years. But you sold it, no? Or 9,35,000. So what goes out? Book value goes out. What comes in? And this is same, no? Foundation. Foundation you have no machinery account. Remember? Okay, sure. So please pause the video and do till 31st March, whatever, 2010, till the asset is sold. Okay, sure. So completed, no? Machinery account. Yes, so we'll just check the answers. Next year, again, 2,50,000 is your depreciation. So you arrived at 17,50,000. From here, our journey starts, because up to there it is a time pass. I don't know whether marks are awarded or not for that. Now, first you charge 2,75,000, and when you have done the revaluation on 1st of April only, PPE to revaluation reserve 1,75,000. And then by balance carried down, you charge excess depreciation, you transfer it. Your accounting entry will be depreciation to PPE. You take out that 25,000 extra, that will not come in your machinery account. That will come in the revaluation surplus account. Did they ask you revaluation surplus account in the question? No. Be careful what they ask you. Otherwise, you will simply lose marks for that. Have they done it? No. So you got the opening balance again. Next year, did anything happen? No. Only one depreciation. You got a closing balance of 13,75,000. Now you come to the last 1st April 2075. Now downward revaluation happened when? 1st of April 2018. By revaluation, you take only 1,25,000. Okay, how did you get this? From working note number 4. Because you had that much of revaluation surplus, no there? 1,25,000. And the total is 1 lakh, 1 minute. 2,06,250 total. But what accounting entry you pass? Did you pass this entry? What is the accounting entry? What is the accounting entry? I want an entry. Revaluation reserve account debit, P&L account debit to PPE. So PPE account credited by revaluation reserve, you have got 1,25,000. By P&L 81,250. Okay, date is wrong there. On the same day we will do. At the end of the year, 31st March 2019, you charge the revised depreciation of 1,46,000. Did we do this calculation? 46,094. You got 10,22,456 opening balance. Now you sell that. Okay, 31st March you charge the depreciation. So by that, what is the total book value? 10,22,656 minus 1,46,094. So 8,76,562 is your book value. You sold it for minus 9,35,000. You made a gain of 58,438. So what is the accounting entry for the gain? Bank account debit 9,35,000 to PPE book value whatever to gain. So 58,438. And gain you will transfer to the P&L account on the sale of the asset, the balancing fee. Yes, everyone got this? Yes, very nice question. Now let us solve some problems on the change in the estimates. So take out question 17, a very small question. And in fact, these things we have already done there. An asset which is costing 10,000 estimated to have a useful life of 10 years. 1,000 every year you charge, residual value 2,000, 800 rupees you will charge depreciation every year, cost means scrap by life. After 2 years, when 1,600 has already passed, remaining life is estimated to be 4 years. Calculate the depreciation for 1, 2, 3. Okay, right? Change in depreciation. Solution. Change in life is prospective application. Because change in the life, change in the method of SLM to WDB, these are all change in estimates, not accounting policy. You change from cost model to revaluation model. It's the change in the policy. So previously you are not transferring, you wanted to transfer, change in the policy. So, right, one, calculation of depreciation charge. First to say that change in the life is only change in an estimate which is prospectively applied. So no retrospective adjustments. Cost is how much? 10,000 less depreciation for 2 years. 10,000 minus 2,000 divided by 10 into 2,600. Yeah, we will do it, no? We have calculated the carrying amount at the book value at the end of second year. See, we will do it. This we can consider it as a working note. First is your cost, 10,000, and again I said 2 months. This is just for your understanding. Then you charge depreciation for 2 years. Now the revised life. So new depreciation is how much? 8,400 divided by. Can you tell me what is my new depreciation? So you got 8,400, no? Sorry? Can you tell me what is my new depreciation? Yes? Everyone? Students, you can also pause the video, work out the new depreciation. New depreciation. 2,100. What got changed? Did the scrap value got changed? Did they say scrap value became 0? No. So when you revise, it is 8,400 minus 2,000. No. Then what happened? No, your book value of the asset becomes 0. You treat scrap as an income at that time. So your revised depreciation is 1,600. Follow? But what is the question they asked you? So these are the working note. 1, 2, 3. No, yeah. Right now, depreciation charge. Year 1, 800. Year 2, 800. Year 3, 1,600. Finish. Perfect. You understood? Previous was a working note. Without that, I cannot arrive at the third year depreciation. First 2 year depreciation is fine. Which one? If evaluation gain was there, then this value would have changed. That will go to OCI, first time revaluation. But the new depreciation will be the revalued instead of 8,400. This would be the revalued. There can be an impairment also sitting. There can be subsequent. See, we have already done the previous question, should have given you a clear understanding how that flow happens. Otherwise, all these are small questions there we are doing. The previous question is a very beautiful conceptual question. It gives you full understanding. That's what, no? If impairment also they would have added there, perfect. Yes. Next question, question number 18. B Limited owns an asset with the original cost of 2 lakh. On acquisition, the management determined the useful life was 10 years. Residual value to be 20,000. So 1,80,000 is the depreciable value. 18,000 you would have charged every year depreciation. Now the asset is 8-year-old. 2 more years are remaining. And during this time, there have been no revision in the asset residual value. That means your residual value remained same. At the end of 8th year, 8 years finished, no? The management revised the useful life and the residual value and determined that the useful life can be extended to 12 years. 2 more years, 4 years are left. In view of the maintenance program adopted by the management. As a result, the residual value got reduced to 10,000. So, this is a combination where the life also got changed and your residual value also got changed. Doesn't matter. You don't separate it and do. It is one change in the estimate, prospective. How would the above changes in the estimates be accounted? Now you have to write, it is a prospective. Previously actually not required. It is a simple calculation. But now you have to tell that it is a prospective. In the new scheme, they said analyze. That means there are components. Analyze means you need to look for components. Examine components. How the above changes in the estimate would be accounted? Okay, there seems to be some print mistake. I don't know what comment I have written here. Question already says that the asset is 8-year-old. Again, they said at the end of the 8th year. What is the problem? But calculations are done as if it is the end of the 9th year. Further, the question is silent on the review of the useful life, whether from the beginning of the 8th year onwards. No, I think they have changed it. One minute, let me see the solution. Yeah, I think no, we may have to cancel this. Your solution seems to be correct now. So please cancel that comment, okay, whatever I have written, because this is correct now. Okay, so first write solution. So change in life or residual value is change in estimate applied prospectively. So how to change something retrospectively, we will study in Ind AS 8. Prospectively means from that year it is going to change. On revision of life, remaining life is 4 years. So depreciation is going to change now. So we'll do one working and we'll tell that what should be the amount of depreciation every year. Because what is the question here? analyze how the changes in the estimate would be accounted. Okay, so we'll do one working note. Where life is going to change. Working note number 1. Historical cost is 2 lakh. Less depreciation for 8 years. How much? 2 lakh minus 20 lakhs. Sorry, 2 lakhs 20,000 divided by 10, 8. 1 lakh 44. 56,000. Less. Now what is going to change is only depreciation is going to change. That's it. Nothing else is going to change. No upward revaluation, no downward revaluation it is. So previously how much you used to charge? 18,000. Less depreciation for 9th year will be 56,000 minus 10,000 divided by 4. 11,500. So instead of 18,000, you start charging 11,500. Simple. This is a simple prospective application of change in the life or change in the residual value. Okay, in the solution, what they have done, they have calculated this depreciation separately. This depreciation, actually they have done 3 working notes. This depreciation, understood now? In the solution, if you look at the ICS solution, they have done working note number 1, how much is the depreciation I used to charge earlier. Working note number 2, what is my book value. And working note number 3, what is my new depreciation. So if you want, you can follow that method also. But okay, this is much faster. So we'll move on to the next question, question 19. Entity acquired an asset 3 years ago at a cost of 5 million rupee, 50 lakhs. Depreciation is 10% on WDV. Oh, first time we are coming across WDV method. At the end of the 3rd year, that means 3-year WDV depreciation is charged. Entity estimates the remaining life is 8 years and adopt the straight line method. You change the method. Is it a policy? No. Again, it is an estimate applied prospectively. So that to reflect the revised pattern of the recovery of the benefits, show the necessary treatment, calculate the depreciation charge or calculate the depreciation charge for respective years. So write solution. Change in method. Did the life change here? They didn't tell you, they said 10%. Okay, at the end of 3rd year, entity estimates remaining useful life of the asset is 8 years. This is needed by, because we are moving into shift online. So we don't know. Maybe originally the life is 11 years, God knows. So here the crux is we shifted the method. So we will focus on the method. If you want, you can write change in the method bar life is change in estimate accounted prospectively. But this is very important. In one problem, you are learning one thing. In exam, they may, rare case, they may mix it. 1 year the life changes, another year method changes, 3rd year scrap changes. Doesn't matter. What is going to change? Just understand it. Whatever these 3 elements are going to change, what is going to change? Will your cost will change? Impossible, because cost is history. What may change is the method, life or scrap. If any of these 3 changes, what you need to do is that year depreciation. What is going to happen? No, it is a change in depreciation. They may make it more complicated by telling revaluation also happening. Okay, but such scenarios are not there. We have seen one small version, like previously revaluation was there. In 2016, 18, they revised the life. What did you do? You just added, you changed that amount of depreciation. You divided the book value by 8 years. That's what. You understood now how to mix it. No confusion. Okay, now let us calculate the carrying amount as on date. Historical cost is 50 lakhs. Less depreciation for 3 years. Now, for me, I cannot simply calculate with one equation here. So, 50 lakhs into 10%, 5 lakh. 45 lakhs into 10%, 4,50,000. Followed, no? Previously we used to do with one single calculation. 40,50,000 into 10%, 4,05,000. So my book value becomes 36,40,000. Now the change happens. And I'm telling you, whenever these three elements change, the only thing is next year depreciation you have to readjust. No other worries. So, done? So, what is your revised depreciation? 36 lakhs divided by 8 years. 8 years. Because you have to see from then how many years they have revised it. So, it comes to 4,55,625. What is the question? Calculate the depreciation charge in respective years. New scheme question you see, no? Show the necessary treatment as per Ind AS 16. That theory we wrote. That's the treatment. Calculate the depreciation for respective years. In new syllabus they didn't. So what I should do? This is my respective. Because calculations we have done there. Or you can do, this is one year calculation. Okay, respective year calculations. You can tell that as a working note. Refer working note number 1. Yes, friends, you can pause the video and copy this. Yes, very simple questions. XYZ purchased an asset on 1st of January for 1 lakh and asset has been estimated life of 10 years, residual value nil. So 10,000 depreciation you charge every year. The company has charged depreciation on SLM basis on 1st January 2014. That means 10, 11, 12, 13, 4 years are over. Management revised the estimated life and decided the assets will be probably used only for 4 years. Total is 8 years. How should it be accounted for remaining years? Can you tell me, students, please? What you're going to do? Please pause the video, solve it, then let us compare. Let us see how do you do it. Whatever you think, what they have asked, and solve it. Okay, students, so we'll compare the answers as a small question. So you say that it is a prospective application, as usual theory. Then you calculate first 4 years, total 10,000 rupees per annum. They need not do it because they already told 40,000. And remaining, since they revise it 4 years with no change in the scrap. So 60 book value divided by 4 years gives you 15,000. Did you get this? What went? Which one? This 30. Why? It's 4 years, no? 4 years are over, right? See, one small thing will change the answers. Be careful. Okay, this is not a conceptual mistake. Here you have to pay more attention to what it is. It's not that you didn't knew it. Something went wrong. Again, think about it. Follow? Yes. Yes, next question is your, again, test your knowledge question, RTP question and test your knowledge question. A Limited purchased a PPE on 1st April 2011. Estimated the life for the financial statement purpose as per Ind AS. What is the original cost and the life they have given you on 1st April? See, that means you purchased a PPE. PPE includes your building, plant and machinery, furniture and equipment. And they have given you the life. So you just divide this cost by the life, you get the depreciation per year. Whatever it will go on. Now A Limited is using the straight line method of depreciation. 1st April 2014, how many years over? 3 years over. The entity reviewed the following useful life of the plant and equipment to an external revalue. After this, they said, okay, total is so much. There was no salvage value changes for the component. Otherwise, again, that would have added. Initially, at the time of revision, compute the impact of the revaluation. Simply they use called revaluation, but what revalued was the life on the P&L for the ending 31st March 2014. Chalo, one surprise question comes to you like this. Now, again, all questions we cannot expect the same repetition of the study material. You have got some understanding and idea. Followed, no? What to do now, how to do it. So what you need to do, see, read the question very carefully. Compute, not calculate, the impact of revaluation of the useful life when statement of profit and loss account on 31st, that 1 year. When the revision happened, 1st April 2000. Did they change? Wait. Maybe print mistake possible, no? Yeah, maybe they can, you can say 31st March 2015. You can call it 15. There is an exam extension, 1 minute. Huh? Okay, friends. So you see, no, previously how much I was struggling to explain to the student. No, it is a print mistake and all. This is what they do. Understand? Don't underestimate them. So yes, in the new scheme, if you open the new open study material, they have said 31st March 2015. Yes, can you do this? Do it. You understand yourself. What is that impact? What they are looking? We'll compare. Yes, friends. So we'll compare the answer. Okay, I have changed that study material, whatever question I have updated here also. So this is the same question. So this is the original and this is the thing. So in the previous study material it was 2004. In the new study material they have given properly. What they asked, they say examine the impact of revaluation of the life or compute the life, whatever impact. Now first thing I will look how much original depreciation I will be charging. So it will be cost by life, I will be charging 10, 10, 5. Did you get this number in your working? Do you do it as a total working or separate working? Separate working, no? So going forward, keep in mind, whenever they ask you impact, you don't show that one working because same working may come in the next one. You give it a separate working. Okay, this question and the next question you have to mark important, probable question for the exam. Then what is the revised depreciation? Now you already charge depreciation based on the original 3 years. This becomes the book value. The revision becomes 10, 5, 7. So revised depreciation becomes 12, 10, 4. You understood my point. Now previous were small questions from examination point, not highly probable. That's why we used to tell, oh, that depreciation working is sitting there only. We didn't do a separate working there. Followed, no? But since this is a high probable question, they asked you with the proper verb and all. So I expect you do this depreciation working separately. Previously, it was part of this working note only. Now, what is the impact? So you have to say that the net impact, original depreciation is 25, revised depreciation is 26, correct? No, 12, 10, 4, 26. Is your answer containing the word 1 lakh? Impact of 1 lakh? Oh, that's very important. That's what they ask you, impact. Compute means 2 previous working notes are going to come there. Understand the pattern of answer? Now what it is? How do you account it? Prospectively, accordingly, excess depreciation will be charged to the P&L. See, first thing, you compute it. Second, you have to explain. To explain accounting, what you are going to do and where you are going to take it. Perfect answer. Followed, no? Yes. We will move on to the next question. Okay, in examination there is one January, Ind AS 10 we will discuss. Very beautiful concept. Huh? You have to be very careful with the institute. See, Ind AS 10 question in examination January, you see H Limited reassessed the useful life of the warehouse 20 years from the date it was ready for use. Always don't, no, this is not there. We will solve this problem in Ind AS 10. Since we are discussing about the revision of the life, I am telling you don't fall into the trap that whenever they say revised, life is revised, from this date the life is revised. Don't get into that trap. It can be possible that institute will tell you that the life got revised from the date it acquired. Yeah, correct. In question number 18, they said it is revised to 12 years. So be careful when they will say. Yes, next question. Yes, students, so you can pause the video. It's the same like a previous question. I don't think so there is any change. Only the format of answer is being different. You can pause the video and work out. Okay, you can take it as 7 o'clock. Note down the answer. Now, yes, it is the same story. There is the building given, life, but cost is not given here. Then they decided to review the useful life, hired an external consultant. Again, they revised for after on 1st April 2014 to so many years. They followed SLM. This is the original cost. Compute the impact on the P&L account 31st March if they decided to change the life of the property in compliance with the recommended valuation. Assume that there was no change in the salvage value and 3 components of the PPE at the useful life revised. Sorry? Amounts also same. Then okay, you can just take it. So let us see the impact. First we calculate the depreciation. I don't think so. Life they have changed. Otherwise first year you got 25 lakhs, no? 15, 10, 10. So it should be 30 lakhs. 10, no? Yeah, the only difference is previous question it was 7 years. This is 10 years. So 30 lakhs. Then revised annual depreciation 15 minus you take the depreciation and then you revise it the revised life. So you get 26. So the impact is I think something they have done. Sorry. 1 minute, 1 minute. This is 35 lakhs by 7 years, no? So 5 only, 5 lakhs. Okay, so then this is 25. So this I need to change. So 35 by 5. So you get the, I think no, I think I took it from their material only, their MTP only. In the solution only they have done like this. Followed, no? Print mistake. Assume, expect these things to happen. So 26 lakhs. So impact is 26 minus 25, 1 lakh. So adjusted prospectively. Yes, with this, we are done with the subsequent portion. Only one last aspect is left.